Thanks, Andy. This is Dave Dickinson, and what I want to do is make sure that everybody has the materials and also talk about what we're going to cover today. If you can go with me to your packet on letter A, the table of contents, what I'm going to explain here is basically A through J in our outline, or pages 1 through 15, is what I call the administration of escrows. It's the coverage, and we'll explain all the definitions and the disclosures that you have to give and those types of things. And then letter K through M, we're going to do the tough accounting. It's aggregate accounting, and it's what you might call HUD math. It isn't necessarily common sense. And so that will break up really the two parts of today's escrow and settlement statements and how you put them on there. Jared's then going to take over and cover basically pages 23 through 26, which is some of the new stuff that we actually threw in here pretty the last minute because it just came out on some of the higher price mortgage loans and how they tie in these two regs together of Reg Z and RESPA. And then behind that, starting on page 27, is the regulation. And we're not really going to reference that throughout the program, but I wanted you to have those 10 or 11 pages back there so that you can see straight from the horse's mouth, if you will, where this stuff is coming from. And then after page 37, there is a series of Q&As from a previous webinar that we had taught, I think it was last year's, and I just like to include those when I can. It's bonus information for you, if you will, that lets you know what other people have asked, and maybe you'll have a similar question to that. So, all right, the last thing I want to point out on this table of contents page is that bullet at the bottom. It says basically anything you see in italics, we're quoting directly from the reg. And if you'll go with me to page 1, you'll see a lot of italics, especially in the beginning. We're just getting the table set. So when you see italics, quote right from the reg, but I also like to tell you where it came from. So you'll notice that in brackets, we're telling you exactly where these things can be found. You can look them up back there in that back part where we said we have the citations, or you can go to your own books or online. Here's the other side of that. When you see words that are not in italics, that means we're just making it up. So, no, just kidding. It's basically our layman's terms, or trying to explain things, our color commentary to it, if you will. So let's get to page 1, Roman numeral 1, and let's talk about what do we mean by an escrow, and what HUD or RESPA, and I guess soon probably HUD is out the door and the CFPB takes this thing over, is that we're talking about a federal-related mortgage loan. That's a 1 to 4 family lien on dwelling where there's dirt less than 25 acres. That's what RESPA. So it's got to be a RESPA applicable loan. And then we're talking about what do you mean by a required escrow account. If you'll look at A1 with me, it's an account under your control. You're mandating, usually through the loan contract, that the borrowers pay in for taxes and insurance, possibly even flood in there, or other charges, and again, with respect to this federal-related mortgage loan. So it's got to be RESPA covered. Let's look at A2 a minute. I'll come back and tie these together. It does not apply to any account that is under the borrower's total control, what we like to call voluntary escrows. Now, this can be gray, and depends on some examiners might have different views. Some will say that if a borrower makes their payment and the escrow comes out before principal or interest reduction, then that's not really voluntary, and I would disagree with that. Our discussions with our client banks and examiners have been that if the bank doesn't mandate it in the contract, but the borrower wishes to have an escrow account, it really doesn't matter how the payment order is processed. It's you're saying, we're not mandating this. Now, to make this clear, go to page 2 with me, and you will see this voluntary escrow letter. It's something that some of the software systems used to produce, and maybe yours still does. I know HUD referenced it back in the mid-'90s that said, if you're going to do a voluntary escrow, we recommend, it's a guideline, if you will. It's not a requirement, but it's a guideline that clearly communicates. So if you're looking at page 2 with me, we're not saying there's anything special about this form, but it does clearly communicate that you're not requiring this. It's a convenience to the borrower. Over and over and over, it says, I wish to voluntarily. And I'm not saying you have to do this. I'm saying you should. We highly recommend, and that will basically eliminate the confusion that you're not mandating these, that these are something that you're doing as a borrower convenience. Now, obviously, there's some reg changes or reg requirements that you have to escrow, like HPMLs. You wouldn't be able to do that. But where it's truly a voluntary thing as a matter of convenience. Let's go to page 3. Let's talk about some key terms here. Now, I'm going to ask you to pick up your pens, your highlighters. There are certain things here that are a big deal. I'm going to have you write down things as we go through this next 2 hours of training. I find that if you write them down, you're more likely to remember them, and it engages a different part of your brain. So there are some things that I especially want you to underline, highlight, write down. Probably one of the biggest things on this page is the first definition. It's the escrow account computation year. If you read that definition, it's not the anniversary of the loan. It's 12 months beginning with their first payment. So if we close the loan in February of 2013, most likely on a mortgage loan there's some odd days and then a full month. So it's not March, it's probably April of 2013 is what would start that escrow account computation year. And so April through March of 2014 would be the escrow account computation year in that example. Now you'll notice I didn't say anything about what day. Look at definition number 5 at the very bottom. Over and over and over in the escrow rule, subsection 17 of RESPA, you'll hear this or you'll see this term month-end accounting, but it's never defined. And this really kind of leads me to a point. I would liken escrows to HMDA in that you've got to read the whole reg and you've got to understand all this, and then you go back and you start reading all the little subsections and all the details, because until you get an understanding of the spirit of this law, it's pretty darn confusing. And I'm not here to cast stones, but I think HUD did a horrible job of writing this regulation. At RESPA in general, but when it comes to escrows especially. So they use this term, month-end accounting, a lot, but they never defined it. And what it means is that days don't matter. When we're looking at low points and payments in and out and all those types of things, the day of the month is of no consideration. What we look at is the last day, January 31st, and February 28th or 29th, and March 31st, and we say, what's the balance on that day? That's all that matters. And so when you start to flip through our packet and you come to some of these disclosures, for instance, go with me to page 5 for just a minute. You'll see that we have listed there November, December, January. There's no look at January. There's a payment in and there's a payment out for insurance, but it doesn't matter that they paid in before you paid out, or you paid out before they paid in, because all we're looking at is the end of the month, what's the balance. Now, some software systems don't do it that way. They might show the borrower making a payment on the 1st and you paying out for something on the 15th. That doesn't matter, and the reason I'm making a big deal of this back on page 3 is the third sentence. The timing of payments in or out is not relevant. It's the month-end balance. That's the only thing we care about. And you might say, what do you mean? When we get into this, we're going to have to figure out what the low point is. What's the lowest point during the year? And that can't be in the middle of the month. It can't be when you pay out for their taxes or insurance and you say, aha, here's my low point, because then maybe they make a payment in. At the end of the month, that balance might be higher than some other month-end number. And so month-end accounting is looking at the last day balance. In and outs during the month are of no consequence or relevance to this. I'm going to go back up. Number 2, cushions. Cushion is basically extra money that you get to have in the account. RESPA allows you to have a 2-month cushion. You'll see it referenced as 1/6. Basically, you get extra money because, one, like month-end accounting, maybe you've got to pay out before things get paid in. That's kind of the justification. And there's also tons of rounding that you're going to see as we get into the accounting side of this. So I've always said the logic behind that 2 months is for those 2 reasons. Number 3 and 4, I'm going to kind of put together here. You're going to have to do this thing called an escrow account analysis. And we'll walk through those 3 steps in great detail. In fact, I'll warn you, you might want to make sure that you have something soft around you, because as we get into that, some of you might pass out, and I don't want you to get hurt by hitting your heads on the table. So get a pillow and put it in front of you. Go ahead and lay your head down. I'm sure that management will understand if they listen to this. Anyway, there's this aggregate analysis, number 4, and again, it's the accounting method that HUD requires. If you've never heard this training before, this might make your head spin. So we're going to get into what that all means in the second